We've been getting quite a few questions lately about whether or not the bear market is over and whether or not stocks should rally from here on. And that's a really tough thing to answer, but I think it's worth exploring. We have seen a little bit of a resurgence in the stock market lately, and prices have gone up. The mood feels a little bit better, but we still have quite a few things that we need to address in terms of how we analyze how the market's doing and which direction it's going in. So one of the things that we look at is, on a positive, is that we still don't have a recession. The Fed has not come out and said that we're in recession. The economy is doing a little bit better. Certainly, from a job perspective, we're at full employment in this country. Housing has come back. It's actually doing a little bit better now. So from that perspective, things look better. And inflation is much more under control now than it was a year or so ago. The Fed, in fact, has stopped raising interest rates, which is what their tool is to help combat inflation. So from where we sit, we think that the economy looks better. So what could derail the economy going forward? Well, one thing to keep in mind is that the rally that we've seen in stocks, in other words, the increase in price, has come almost exclusively from the technology sector. And if something were to spook the technology sector, that could have a real negative impact on the market. We saw this in the year 2000. When Y2K was a big fear, and we all thought that, we wanted to make sure that all of our software and our hardware was up to date. People spent a lot of money on technology in the second half of 1999. Well, January 1st of 2000 came, Hoover Dam didn't stop working, the internet didn't stop working. So Y2K never really happened, but the demand for technology in the first quarter of the year 2000 was pretty much non-existent. And as a consequence, the technology sector got crushed and the whole market suffered as a consequence. So we want to keep a close eye on things to make sure that doesn't happen. Obviously, one of the best ways to protect against that happening is to have a more broad-based rally where sectors are not just technology that's doing well, but all sectors of the economy are participating equally. We haven't seen that quite yet, but we're seeing more of it lately. So what else could derail the market? We're getting into earnings season, and stock prices are a function of corporate earnings. If earnings are compromised, if people aren't hitting their targets, if companies aren't hitting their target earnings numbers, this can have a negative impact on the market as well. So we want to keep a close eye on that. But in general, the stock market has done pretty well. In fact, since the end of the third quarter of 2022, the S&P 500 is up just about 21%. And by any measurement, that is a positive sign, and we feel pretty good about that. But we keep an eye on the markets, and we're going to make changes when we think they're warranted, based on where we think different sectors of the economy are likely to do better or worse. We'll make changes accordingly. But if you have questions, we want to hear from you. The question that is probably the one that is, the least meaningful is the one that never gets asked. So if you have a question about the economy, if you have a question about the markets, feel free to pick up the phone or shoot us an email, because that's what we're here for. The other thing that we want to make sure that you understand is that one other factor driving the markets is something called the fear of missing out. The kids call it FOMO. And the fear of missing out is a very real thing, because what happens is investors that missed the rally the last time it happened don't want to miss it now. So a lot more money is coming into the market today as people anticipate that perhaps we're going to see things go up from here. But we still could have a recession. There are things out there that we can't control, that we don't know yet, but we can react to them appropriately. And that's what we do here. So I'm Ray Dunlap. I am the CEO of Dunlap and Associates. I appreciate you watching this, and again, our phones are open, our emails are open. We'd love to hear from you. But one thing I want you to take away from this is things are better today than they were a year ago, and that's a positive. So hang in there and let us know if you have any concerns. Thank you very much.